Hey everybody, welcome back to the Perfect Portfolio. And of course, we have Mr. Danilo Lambo to my right here. And we're just talking about cool opportunities. When the markets go down, there's just all kinds of great opportunities right now. And I see we have lots of our current students for the course here and just a bunch of our past students, which is great that our students are coming back to continue raising their financial IQ. And as you know, the Perfect Portfolio has three goals: is to automate your income. It's to raise your financial IQ, teach you to fish, and then automate your income. And that was the purpose of this course. And that was almost 2.5 years ago. And it's just amazing how many people are actually, figuring out that they may not need to work for the next 5 years or 10 years. They might be able to, get financially independent in 2 or 3 years, things like that. So very excited about the person we have to talk with us today. Let's see, I met Bronson and I was like, man, as soon as I met Bronson, I was like, man, I really, really like this guy. Like it was like an instant, connection there. Just because he's also recovering investment advisor, right? He was one of those guys
Sure.
who used to sell those mutual funds and 401ks and Roth IRAs and stuff like that with a diversified portfolio of stocks and bonds. And then he, woke up one day and he goes, wow, there's just so many other cool things out there. And so he did the same thing and, decided to go off in a different path. And I know he's like, he walks the walk, he talks the talk. I know he's, not paying a lot in taxes, which is, a big goal of our students.
Yeah.
And just got lots of cool stuff. And I endorsed his book. So awesome, guys, get this book on Amazon. It's actually really cool. It's like simple. It's my style. It's simple. It's to the point. Today, now I know the Perfect Portfolio, we're definitely out of order in this class. We wouldn't normally bring Bronson on until later in the course. But again, the purpose is to raise your financial IQ. And we've only done the overview for this course. So I know some of our students are like, whoa, we're jumping in. But I think it's important to understand that alternative investing is a huge, huge part of building passive income streams. And, Bronson's the guy to do that right now. So expert in multifamily real estate investing. Again, fellow author, hangs out with the big dogs, right? Like Ken McElroy, which is Robert Kiyosaki's guy, and that sort of thing. And then also, we're going to talk about ATMs, I think, and oil and gas and depreciation and all that cool stuff. So without further ado, my good friend Bronson Hill, I'm going to pass it over to you to do your thing, man. So
Awesome, Mark. Well, really great to be here. I feel the same way, man. Since we connected, it's kind of a funny story. I was on a plane and I had my Kindle out and I found this book that was like 10 ways to pay zero taxes. I was like, that's a book I want to read. So I just went through on a flight. I just devoured it. I was like, this sounds awesome. And then I actually reached out to Mark, realizing he was in LA. And then we kind of got in touch, and then he came and spoke at our meetup. We have a local meetup in Pasadena or Glendale, California, which is great. So, and actually, we have an event coming up later this week that you're coming to, and you guys are going to be at, which is going to be great. So,
I will be there. I will be there on Friday, and we have this. Anyways, we have some cool stuff. I'm excited to be there just because I want to learn as much as I can and make some good connections. So
awesome, man. Well, I'm excited. Well, there's a lot we can talk about. I know I don't want to overwhelm anybody. I feel like in general, the name of the event we're doing is called the Advanced Real Estate Investing Summit. And the word advanced can feel a little bit intimidating, but I always feel like it's better to be in a room where things are a little bit above your head versus things are too simple. Would you agree with that? Kind of everybody just that, if you're in a room where, I didn't understand that term, or I don't know what that means. Then that's a good note to write that down, go ask a question, look it up, try to research it out for yourself. So hopefully you'll hear something tonight that's really valuable for you. Mark, I have, I think like I talked about, we could talk about ATMs, we could talk about car washes, we could talk about oil and gas, we could talk about all of it. So how should we start? I can just go through the presentation.
Tell us your background. Like, how did you go from, financial advisor, with the suit and going to sell mutual funds to where you are today? What did that journey look like?
Yeah, so for me, my background was medical device sales. So I was doing, I was in a sales role. So I would wear scrubs and go to surgery. This is for about 10 years. I did this, and the whole story of how I got into that, and I enjoyed it, and it was good. I knew I wanted to experience financial freedom, though. Even though I was making over $200,000 a year, but I worked a lot of hours, working sometimes, 50 hours a week to be able to perform at the top level. And so I wanted to have, the ability to travel. And so I wanted to create a life where, instead of me working for money, my money would make money while I sleep, as Warren Buffett says, right? So I kept, pursuing it. And what I found is I tried different things. I tried investment advising. We've talked about that term, a recovering investment advisor, the RIA.
Yeah.
And so, I'm not a licensed person anymore, but I'm thankfully not licensed, because I can actually tell people really, hey, I don't think these investments are great for you. Here's what I think you should do, and make your own decisions. But anyway, it's a great education to learn. I started actually in single family homes years ago. So this was, about 18 years ago. I had my first single family house, started buying single family houses, had a small portfolio. And a lot of people think, you may think about this as well, just subconsciously, that I'm going to get wealthy and have financial freedom and passive income through real estate. And what really we go to a lot of times is like, well, I've got to buy another house. I live in a house, so therefore I'm familiar with it. I should buy another house. I can rent that out, whatever. But these days, and just in general, it's very difficult to actually cash flow much from houses. So the idea of how much is your money actually working for you? So if I put $1 million into a house, I've still got expenses. I've got the mortgage. I've got repairs. I sometimes have bad tenants. I've got a management company. I've got all these things. After you pay all those things, especially in Southern California, you're probably not making any money. You're probably actually losing money, right? So I had this portfolio of single family houses, and I realized it wasn't going to get me where I wanted to go. So I had this plan of getting 30 of them, and eventually it would scale. And I had a cousin who just, had been doing multifamily for years, said, hey, why don't you do multifamily? And I said, well, that sounds really advanced. I don't know. I don't have that kind of money. And he said, well, you can raise the money. So I learned about this thing called syndication, which is just a fancy term for raising money from other investors. It's been said it's selfish to just use your own money, right? So if you can actually help other people to get, so we've really created a way to do that. It's not selfish to use your own money, but the point is there. So over the last 5 years, I've been able to do a lot of things in real estate. We have about 2,000 multifamily units. We've raised money for car washes, for ATM machine funds, which I can explain, into oil and gas deals, different types of deals. I've raised almost $40 million from retail investors. And you're like, well, how do you do that? And that's just 50 to 100,000 or a few $100,000 from each investor, and you compile it and you go buy a big apartment building, or you go put it into a certain deal and a certain asset. So that's really how I got started. And again, everything I've learned along the way has just kind of added to. And so that's something that wherever you come to finance, you come with your own background, whether you're a physician or you have money or you don't have money, you just bring the skills and the experience you have. And there's a lot that you can do with that.
Yeah, for sure. And then how did you end up meeting Ken McElroy? I mean, because I remember reading his books. I read Rich Dad, Poor Dad, and then I went off into the real estate one and all those ones. How did you end up connecting with Ken?
So we were at an event together. We were at, sometimes when you go to these expensive events and you pay to be in the room, you get other really amazing people in the room. And sometimes there's almost a correlation. The more you pay, so this was it was actually like a $7,000 week in Belize. And it was there, and I had some mutual friends. So I just was talking to him, asking questions. We hit it off and connected. And he's a guy. He's got about $2 billion in real estate assets. He's been doing this 25, 30 years. And he actually wrote the foreword to my book, which you held up. It's also behind me here as well. So it's not out yet. It'll be out officially. The full release will be November 1st. So yeah.
Cool. Very cool. Very cool. So, well, it is a cool book. And I'm not even saying that just because you're here, but it is a really cool book. It's simple. It's easy to read. And I just like that style of reading a book. So, but no, what do you, I know you're talking about ATMs and stuff like that. I think that's something pretty cool. I mean, I didn't know you could even invest in ATMs. I think I see like Instagrams where people are like, oh, get an ATM machine. But like, I don't know how to get an ATM machine, or how do you go buy a car wash? Like, I don't know. Like, what I mean? Like, is it like a syndication kind of deal? Or how's that work?
So like a syndication. So, the whole thing in my book talks about this too, is the goal is not to, get in as many deals as you can. And a lot of times, let's say I did get to the place, when I quit, I had about 5 single family houses. And it was a lot of work. Even though I had a property manager, I was still getting the calls of, hey, what do we do? The toilet's broken. The tenant destroyed this thing. The neighbor, there's some issue with the city. All this stuff would happen. So the issue sometimes is the more money we have, And sometimes there are systems that are a little more active, and then there are things that are truly passive. Now, a great passive investing deal, typically somebody approaches that where they have more money than they have time, right? If you have more time than you have money, then being active is okay because you're leveraging your time, right? You're doing a flip, you're doing some sweat equity, you're putting it into some trading strategy, you're doing things that are a little more active. And so it just depends really what your goals are, if you have more time. So what I've realized is if I can find partners, for example, the ATM fund is the fourth largest operator of ATM machines in the country. I started doing this as a passive investor 3 or 4 years ago. At first, I was a little skeptical. I was like, does anybody use ATMs anymore? Like, what the heck?
Exactly.
It's like, we're going digital dollar. What the heck? I don't use an ATM. Yeah. And that's like the biggest hurdle, actually, honestly. A lot of the people who invest in ATMs never use ATMs, but the FDIC said that 5% of American households, not a single person has a bank account. You just think about it for a second. They don't even have a bank account. So they're using prepaid debit cards. They're operating in cash, sometimes on the table. They're sending money overseas, all this kind of thing. So and we're actually seeing a growth rate I can share. It's about a little over 4% growth in the ATM transactions per year, consistently and projected going forward. So that one's just been super consistent cash flow. So whatever deal you look at, there's all kinds of deals we do. Some are super high, 10 to 100x type return. So that's obviously more risk. There's ones that are steady cash flow. There's ones that are kind of a mix of appreciation and things. The ATM one's just super consistent cash flow. It starts paying month forward. It pays out every single month. And, deals like that are really unique, especially these days where, some real estate valuations, especially commercial real estate, is down. I know you have an awesome cash flow strategy that you're using. And so that, but those strategies, I think if you have a choice of appreciation versus cash flow, I would take cash flow all day because cash flow allowed me to fire myself and quit my job and be able to have that, cash flow coming in and stuff. So, yeah.
Yeah, absolutely. Yeah, and some of our students, like in the future, we love to buy, borrow, die, right? You can invest in something we're doing, and you can borrow from that, which that's money that's not taxable when you borrow it, and then when it goes into the investment, that's a very good big tax deduction, right?
Yeah.
Then it starts paying you about 4 months down the road. So that's huge. You're basically sort of double dipping in the tax codes and lots of tax avoidance in there. So it's kind of a cool thing, right? So maybe tell us a little bit about how that works.
Yeah. So it's interesting about taxes. Again, I just disclaimer, I'm not a tax advisor or a CPA or anything, but I went from paying about a 25% effective tax rate to about a 1%. And how I did that, guys like you and I, Mark, we just love that. Like, oh, tell me the story. But there's this really cool thing that if you look in the tax code or you search on Google, you search IRS real estate professional designation or IRS real estate professional. And all that means is somebody that spends 51% of their time doing real estate related activities, actively managing, you have a portfolio, you have investments, or it could be your spouse, right? So if you qualify, what it allows you to do is to use deals like the ATM fund or other, multifamily, other sorts of deals that have lots of depreciation, and you can use that against ordinary income, or you can use it against your spouse's ordinary income. So we've seen people, I've saved the last, I think 2.5 years since I left my job, I've saved, over 100,000 in taxes that I would have paid, right? So I realized if I was able to figure this out, I could make, instead of making 200K a year, I can make 150, and I was making just the same amount of money. So again, and why does that exist? Why do these things exist? People call them loopholes. I really call them incentives because the government, they have to provide things like energy and housing, and they're really not good at it. So, government housing, what does that look like? You look like Section 8 housing or projects. Somebody live in a government project, they don't live there, right? But if they partner with us and give us tax breaks, we'll go do it, and we'll do a much better job than they would. And so we get to kind of partner with them, and they incentivize that.
Yeah, and for those students, again, we're when we're jumping into like advanced real estate professional status, it's good to hear something you'd never heard before. But let me simplify this really quick. So you have depreciation when you're renting properties. So if you collect 20,000 in rents and your depreciation, they say the property is going down by 20, there's no taxes on that. But with a real estate professional status, I'll give you an example where this is. If you have somebody who's a high income earner, and by the way, me and Stella are putting together the pieces. So income's going up, we're like, man, we're going to pay a lot in taxes. So we're going to buy real estate in Tennessee. And then Stella would basically benefit from not having a job. She can work in real estate 51% of the time. And that gives us uncapped depreciation. There's things called advanced and accelerated depreciation. We can kind of bring the depreciation forward on your real estate. And because it's active, it can wipe out our active income. So we can literally pay like nothing in taxes, but you have to have one person working in real estate at least 51% of the time. I think that was a good sort of a summary, but we'll cover that more in details. But just to give you guys a, kind of a idea of how that looks. But again,
a synopsis of it.
Yeah. Now that depreciation kind of carries over to ATMs and car washes and oil and gas and stuff like that. Just like you can depreciate your 6,000 pound Tesla. You can literally go buy a $120,000 Tesla, put 10 grand down and write off almost the whole car. It's up to 80% right now. So depreciation is when you're using stuff in business, you can do it. And that's why all these rich politicians in San Francisco drive Teslas, because the taxpayer pays for half your car.
Well, and it's amazing too. And we'll see a lot of times, we really specialize with business owners a lot, where somebody will have, it's very common, somebody will sell a business for like, $5 million, or, there's this, a couple of dentists that are brothers in California that I know, and they sold a business, the stories in my book, they sold a business for around $5 million. And they were able to pay a total, their tax bill was close to 2.4 million. If you look at the actual taxable basis, and they got it down to 125K. And they would have been zero, but because they're in California, they had to do this land trust thing. But there's just amazing, and I tell the story in my book, but just like there are consultants that do this, that just kind of figure out, okay, how can we get you into a better place? And some of it's if you have a sale, or the big thing is a big gain or something. Can you put it over multiple years? Can you, have other write-offs? Can you have other things that working as active income? Like those guys, for example, they put in, close to $1 million between the two of them into the ATM fund because their wives were both real estate professionals. So they could use that depreciation against their ordinary income. So it's just amazing. It's kind of like, how creative do you want to be? And again, I working in California, living here for 15 years, but for 10 years, I was doing medical sales. And it's these physicians that were paying over 50% in total, federal, state, and other taxes. Yep. And it's just like, and they just thought, well, that's the way it is. But, it's just really trying to understand, is there a way to do it? Is there a way to ethically do it? Is there a way that you can find a way around it? Again, it's not a loophole, it's an incentive. And if you can find a way to just do what the government wants you to do, then they'll incentivize you. Yeah,
it's crazy because you have active and passive income. Let's say that, income's cranking in the business. We're in Tennessee. Let's say Stella quits her job and just works in real estate. Now, she doesn't have to get a license or anything, just working in real estate for 750 hours that year. Our depreciation can wipe out our active income. You can literally pay nothing in taxes. Our friend does that lives in Tennessee. She makes tons of money and she doesn't pay taxes, and she gets the free health insurance because she doesn't make any money. I mean, it's crazy. Like that's, and that's how everyone's doing it. That's how they're not paying taxes. That's one of the ways anyways. So, and that's something we cover in the course. So this is a cool thing to just talk about today. But again, I didn't know you could invest in car washes, ATMs, and all that stuff. So I had one investment in oil and gas, but it was bad. It was right after 2008 and it just disappeared. Like it was like money was gone, and it's gone. It was gone because the 2008 crash, it just crushed it. So, so.
Yeah, and that's a good point too. And whatever you invest in, you've got to really understand, what are the risks, what's there, and there's just some things you can control, some things you cannot control. But having some diversity, I think, is good. So
yeah, definitely. So, is there a specific slides you want to cover with us today?
Sure. Yeah, I think let's go over. Let's talk about the ATM fund, just because. Again, I think the best way, I'm not pitching this to anybody here. It is, something we offer periodically through the year, but I'm just going to present it as how we present it. So you can see kind of the plus and minuses. And I just try to, this is an educational meeting, so this is not a pitch of anything, but it is presented in a slide deck. So I'm happy to share that. And then we can slow down if there's questions or people want to walk through it. But I think getting familiar, I think on the educational side, Mark, you'd agree with this, is getting familiar with different assets. It's like it puts different arrows in your belt, or even just, it's almost like you have a tool belt. You have different things. Oh, I've got a hammer now, or I've got a drill, or I've got, you've got these different things you can use for different situations. And if the more skilled you are at that, the more you'll be able to see opportunity, right?
Yeah. We have like these things like 7 levels of financial IQ in the course. One starts at like, I don't know anything. And then there's save money. There's save money and get good credit. That's level 2. Level 3 is I save money, get good credit, max out my 401k to save on taxes and have a Roth. That's level 3. And then it's like, I have OP, but somewhere I'm a sophisticated investor. And I remember reading that like 23 years ago with Robert Kiyosaki. He said, become a sophisticated investor. I was like, what is that? Well, he defined it as somebody who's gone through the ups and downs. They've invested in this and this and this. They lose money, they make money, they're getting their financial education, but they're sophisticated. Like I can invest in, and many of our students can do this, by the way. And they came in and said, I don't know anything, but now they can invest in stock options, leveraged ETFs, synthetic covered calls, all these different cool things that are out there. But again, if you just raise your financial IQ every single day, this is a good opportunity to do it, because you're not going to hear about this stuff unless you go to a sort of a specialized group. So I'm excited.
A traditional type of investing.
Yeah.
So it's actually looking outside of the general box that just gets marketed every day, and usually that's kind of where the opportunity is. And if you understand things in your financial IQ, you understand where you can see opportunity that benefits depending on the objective, and utilize it, like you said, that analogy of a tool. It's just a tool to fit your overall objective. So what is your goal? So it's good to be exposed. Once you're exposed, it exists. Once you exist, then you can continue your financial education. So
for sure.
Exactly. I'll go ahead and share the screen here so you guys can see. We'll go full screen. Give me 1 sec here. Okay, you guys are able to see this?
Yes.
Okay, so this is the ATM fund. This is just kind of talking through what it is. Again, disclaimer, this is not an offer for sale. This is just, in this case, it's just educational. This is a little bit of my background here, 200 million in multifamily assets. Then we shifted to do a lot of alternative stuff, particularly last year and a half, 2 years, as lending has changed. And then we have monthly investor events in LA. And then I've been a part of this fund initially, and then I brought it to my investors. Cool. So I just want to share what I like about ATM funds and this particular group as well. This is the 11th year in operation. It's the 4th largest operator of ATMs in the US, about 25,000 ATM machines. So it's a very large operation group. They're the cash flow. We talk about the importance of cash flow. And again, I don't want to say I debate investors. I've had actually over 1,500 individual one-on-one phone calls with high net worth investors just over the last 4 or 5 years. And I always ask the question, what's more important, cash flow or appreciation? Maybe this. But I always think cash flow is just so awesome, because, if you have like a lot of money someday, that's great. But like, if you have money in your account this month, you can actually it can actually cover expenses. You can make different choices. You actually live off that, which is great. So there's not a lot of speculation there. So this one, it basically 104K. There's a reason why they say 104K invested. It's increments of 52,000. It's a preferred return, which the word preferred return, it's not a guaranteed payment, but it means if there is cash flow available, then you get paid first, which is always good. So it's good to be preferred, right? It doesn't mean it's guaranteed. This group has not missed a monthly payment in over the 11 years since starting. So this one, 104K invested, returns around $2,162 a month. And you say, well, how? That seems like a lot of money. And it is, but it actually is a mix of principal and interest. So you're getting your money back. Some of it, you're getting a return on the money that's in there. So one is called return of equity, right? The money you put in is your equity that you can return, and then you're getting return on your equity. So one thing I like about this as well is that you get about half your money back predictably within a couple of years, and you can reinvest, right? So that's kind of a nice thing that it's like, I don't quite know what to do. Well, this is a nice investment that's kind of a midterm investment. You kind of figure out, okay, what you want to do. There's no financial leverage, so there's no interest rate risk. It's all a cash deal, which is kind of unique. It's an uncorrelated asset. It actually does well during recessions. During COVID, there's some data that showed that we actually were between 90 and 100% of the normal usage within just a few weeks after COVID had started. So people were finding a way to get to ATMs and using them. And it's 100% depreciation. We talked about that depreciation. What that means is that 100K or 104K invested would produce over the 7 years, a 7-year investment, it will produce 104,000 in passive losses that you could use against any sort of gains from this deal. So again, any sort of profit you get from that, you can use it from that, or you could use it toward other gains that you had in other things. And it's 80% year one. And I say here, it's better depreciation than real estate. Again, I know this is kind of new for some of you guys, but with real estate, there is a thing we do where we bring forward a lot of the depreciation. We call it bonus or accelerated depreciation. And whatever, let's say it's like your house, for example, you get a little bit of depreciation each year over 27 and a half years. So you take the whole cost of the house and you can divide it over 27 and a half years. The IRS gives you a credit on that amount. Well, it's the same with multifamily, except we can bring forward a lot of that depreciation year one. The problem is if you sell in 5 years, you recapture, you have to pay back the other 22.5 years you did not use. This one, you don't recapture because it fully depreciates to 0 over 5 years. There's no recapture. So that's kind of a high level. Again, if you have questions, you can always put them in the chat here too. I'm sure there'll be some questions on all this. Again, just keep your mind open to think, okay, do I understand kind of how this works and what's the investment profile of a deal like this? So this is the team. I'm happy to share this or email it to anybody if you want. This is some of the people involved with it. I don't have to really get into this. There I am. There are some of my partners on this deal. Just to clarify, I'm not the one who's actually operating this deal. I work with partners that basically are the ones that are actually doing the operations. So this is their group here, over 25,000 ATMs in over 12 states, operating since 2012, and grown mostly through acquisitions. The guy back here, his name is Daryl Heller. It's the main guy here. He has about 15 different companies involved with, just kind of a serial entrepreneur, and he finds a way to grow through acquisitions. So he'll find groups that have, 1,000, 2,000, 3,000 ATM machines, and he'll find a way to leverage and buy them out, and then to be able to grow the portfolio that way. So that's who my partners on it. This is the investment structure. This is accredited investors only. So somebody has to have a net worth outside of their home of over $1 million. Have you guys talked about being an accredited investor, the importance of that, or what that means?
We haven't had the chance to talk about that because this is a kind of a new group of people. We kind of just said, hey, let's.
Okay.
So, but we do have some accredited investors in this group for sure.
No worries. So I just basically have, there's either a net worth requirement or there is an income requirement. I'll just say that. So you have to qualify. It's not a gold star. It's not like you take a course or anything. It's just that you have to have a certain level of income or net worth. The investment size is increments of 52,000. It makes the math a lot easier. This was for a prior fund. So, there was a closing date that we had on this, and then the preferred return starts 4 months after. So after investing. So the one that we closed last month will start paying out the end of January, right? So that's kind of generally how the investment works. But let's talk a little bit, and this is important no matter what asset you look at, is what is the actual market for that investment look like? If you're looking at multifamily properties in Jacksonville, Florida, like we do, well, what does that look like? What is it? What are the landlord rights? What are the tenant rights? Is it a growing population? Is it a shrinking population? Is there a lot of business, a lot of jobs there, those kind of things? Well, the same with this. We want to understand who is using ATM machines. Well, we're finding that people that, cash workers, immigrants, people on government benefits, people that have legal judgments, and people that are wealthy but don't want to have their money. If they put it in the bank, it'll be garnished. So they do a lot in cash. FDIC report, like I mentioned, 4.5% of households are unbanked and 14% are underbanked. And basically, there's some articles talking about it. The bank-owned ATMs are going down, but actually the private ATMs like these are actually being increased. And those that invest in ATMs, like I mentioned, usually don't use ATMs. So it's a different demographic, and there's a lot of cash and prepaid card usage. So that's who's using this stuff. Feel free to jump in, Mark, if you have any comments too. I'm just going to keep going here. So there's this FDIC report that we talked about. I mentioned that the 4.5% of households are unbanked, meaning that no one in the household has a checking or savings account. This says 10%. So that was 5% of households, 4.5% of households. This is 10% of Americans, or people living in the US, I should say, don't have a savings or a checking account, right? So there are a lot of people here that are underbanked. So a lot of these people are using things, even the underbanked here, they're using alternative services like payday loans, credit card debt, other things like that. So these people are all using ATMs, to some level. And this is the ATM market. It's a little shocking. It's a little fuzzy on how it looks here, but this is kind of shows the growth. We're looking at basically it's around a 4.3% compound annual growth rate. We're in 2023 here, but we've seen how it's grown, just the usage of the ATM machines over the years, and we're seeing that continue. So it's not like it's booming, but it's definitely growing. It's definitely not shrinking. There are risks involved, if we, and we'll talk about that here in a minute, but in general, we see a pretty good trend line, right? And I'm going to talk about why this opportunity exists.
And honestly, Bronson, one of the interesting things too is, a lot of those underbanked folks across the states right now are starting to use check cashing firms, things like that. But a lot of states are actually going after check cashing firms and shutting them down because they've been doing a lot of kind of under the table stuff and trying to avoid the paperwork and things like that. So because of that, you're going to see even more folks driven towards ATMs because they're not going to have the ability to use the check cashing services they did previously. New Jersey, for example, over the last year has shut down almost 25% of their check cashing firms. So
right.
You're going to see a lot of that nationwide. You're going to see a lot more people driven towards ATMs because of it.
Yeah, and you see that it's exactly the trend here too. You see back here down in 2016, you have 302 billion. It's a great comment, AJ. 302 billion, and then in 2020 it was 377 billion, and in 2023 468 billion. Now this is this is for prepaid debit cards. So these are people that are using them. So even you can have a prepaid debit card without having a bank account, and so that's why people are doing this. It's outside the financial system, and I mean that's $500 billion that is being utilized through these cards. And so we're seeing a lot of usage of these as well. So how the fund actually works, and just going to talk about how it really works. So ATMs generate fees. Typically they generate $2 to $4 per transaction. The fees are split. The location. So if you're, own the convenience store, you own the hotel, you usually get a cut of about 30% of those fees. The operator, our partner Paramount, gets about 40%, and the investors get about 30%, right? And some of these locations have 2,000 to 4,000 transactions or more per month, right? So you do the math, and it's like, that's a lot of money coming in through just one little thing. And we say, well, this really isn't real estate, it's ATMs, whatever. Well, in a way, it really is real estate, right? It's this little 3 foot by 3 foot, or whatever, this little slice of real estate in the right location, in a convenience store or at a nightclub or at a hotel, and it's just in a great spot. So that's kind of how that works from a return standpoint. The investment timeline: investors invest and receive 84 preferred monthly payments starting month 4. The payments, like I mentioned, are a mix of principal and interest, and it's diversified. It's not like, okay, this is the ATM you own, or these are the few you own. It's actually diversified over a fund of several thousand. And so, if one is in a poor location, one's in an amazing location, you get kind of diversity from that. And the operator only gets paid if the investors get their full 24.9%. So there's some seasonality, but they are able to ride that out, so it's consistent for the investors. This is kind of a breakdown of how it works. You can see here the payment, the cash on cash. Some people see this number and they're like, that's just crazy. Like, how could you have a 24.9? Again, it's a mix of principal and interest. The most important number here is this IRR number, is 19.4%. So IRR, and I try to explain this to people. This is important when you look at deals, because if I had a real estate deal, and let's say you didn't get paid anything for 5 years, and then you doubled your money, right? So you'd be getting 100K, and you get your 100K back in 5 years, and you get another 100K, right? But let's say that would be a 2 equity multiple. You'd basically double your money in 5 years. That sounds great. Well, what if the same thing happened, but in 5 years, instead of getting it back at the end of 5 years, let's say you got 90% of your money back in year 1, right? And then you just had 10% going, you still get a 2 equity multiple over 5 years, right? You double your money, but you have the ability to reinvest sooner. So that's where this number, IRR, internal rate of return, it takes into account the time value of money. So to be able to have that type of return, to be able to reinvest, I think is pretty great. So on this one, generally 104K invested returns around 184,000. Again, it's not guaranteed. This is the projection, but it hasn't missed. In 11 years, could it miss? Of course it could, but hasn't. Again, this is what I was sharing about, and this is actually from my book as well. If you look at multifamily or real estate deals, typically you'll buy a deal after a short period of time. Hopefully it will start cash flowing. You'll get cash flow, you get some cash flow, and then you get a bit of lump sum at the sale, and you get your principal back at year 5, right? Well, this one, the way it works is, month 4, things go by, all of a sudden you start getting paid, and you just get paid the same set payment. And then at the end, you've got all your money back and your return back, and the investment just ends, right? So it's, again, it's for people to kind of get their head around how that's structured. I think it's just helpful to kind of see it and think it through, and we can certainly answer questions on that as well.
Yeah, there was another number says cash flow with depreciation. That was a 39%. Maybe you just give us a little bit of insight on.
Yeah, sure. And we got some questions about the future of ATM with the digital dollar, as well as the Bitcoin ATMs. We'll get into that as well. We can spend some time with that.
Cool.
So this basically is looking at, if you're looking at it with depreciation, I have to break down each one of these numbers, but the ROAR, I didn't put these slides together, but it's just saying, what is the average return? 16.7%. When you look at it with the depreciation benefit, this is assuming somebody has, maybe they're in a 35 or 40% tax rate. They're able to use that against, maybe you had other deals where you have gains from. Now, if you're not a real estate professional, like we talked about in general, and you're not using market strategies and you're whatever, you're going to pay normal tax rates, right? So if that's 35, 40%, even sometimes on other investments, sometimes you'll have investment or capital gains, which is a lower percentage, but this is basically taking into account depreciation, the depreciation benefit as well. So this is asking here the payback. How long does it take to get your money back? Just over 4 years. But if you count the depreciation, it's like 2.5, right? So again, those are important things to know. Well, when do I get my money back? And when you count other benefits, what does that actually look like? Well, it could be as low as 2.5 years if you're counting the depreciation you're getting as well.
Cool.
Yeah. I think I just have a couple more slides here and then we'll get to questions. But diligence, I just went back recently, did a bunch of diligence with these guys. We've raised, I think for this fund, we've raised about 13 million for this the last couple of years. I've invested and then also, brought a bunch of investors to it. Looked at the financial records of operations, saw a master list of the ATMs for our funds, examples of our current ATM contracts, and reviewed the ATM portal fees and transaction volume for specific locations. I toured a warehouse. It was kind of wild. They have these, where they have all the new ATMs in there. They've got 100 new ATMs. They've got probably 1,000. It's like a junkyard. They've got 1,000 old ones, and they're able to kind of use them for parts, which is kind of cool. Saw their bank letter of good standing, which is actually, it's kind of interesting. The ATM opportunity exists for retail investors, I think, because I always ask, why is a deal here? Why is, if the returns are this good, why is this deal here? And the reason why, one of the reasons why, is because it's lumped in the same financial category as things like payday loans and title loans and other pawn shops and things like that. Like a lot of places just don't want to work with it. The second thing is that with ATMs, because it deals in cash, I mean, literally in these 25,000 ATMs, there's over $200 million in cash that's literally just sitting on all these machines. So there's a lot of anti-money laundering regulations. Certain banks can't do it, don't want to do it. It's just a challenge for them to do it. And so a lot of places don't want to get involved with it. So that's kind of why this exists. Like here's a picture of kind of the junkyard with all those ATMs there, which is kind of interesting. Some of the contracts we looked at, and here's some of the new ATMs that came in. So it's nice to be able to do some diligence on that. This is, sorry, my screen is a little split here. So the primary risk, let's talk about risks here, right? And this was kind of brought up in a question. What about people that stop using cash, or we go to credit, or we use CBDCs? And this is legitimate, right? Like there's a lot of talk about, things are moving to credit cards. You may feel like, dude, I mean, for me, I use credit all the time. I don't pay an ATM fee unless I'm traveling internationally. I was in Japan last month. I used an ATM there and paid a fee, but other than that, I really don't. But again, you're not the people that are using this. It's a different type of person. This conversation has really been there since, I would say, the 90s. Like, ATMs are going to go away because credit cards are here, but yet we're still seeing people use them a lot. So people are really, now there's actually places that we're seeing now where they're actually creating laws. Like in DC, they made a cashless ban where during COVID, a lot of places started banning cash and saying, oh, we don't want to take cash, only card, whatever. Well, that actually discriminates against people that are using cash. And so DC actually made it like totally illegal for stores to not accept cash. And so there's places we're actually seeing this happen where they're actually forcing it. Second thing here is the CBDC. If you look at China's a really interesting example. I'd love to hear, Mark, if you have thoughts on this too, but, they're an authoritative government. There's not a lot of privacy for individuals. They do have a social score for people. So if somebody's known as a troublemaker, it lowers their social score. They're able to get less, effective terms of credit. They really can get harmed in society and functioning in the economy. And the question is, what is the benefit for Americans to have a central bank digital currency? Okay, well, you don't have to carry cash, there's things, but it gives the government so much insight. Right now, they'd have to go and collect all this stuff. Some would say, well, they have all the information anyway, but I say, well, it's really not centralized. And with central bank digital currency, they could literally put money in your account and say, you cannot use it for these things. You only use it for these things. And you look at privacy issues. You'd say, if you're a gun owner, well, you can't buy guns. You can't buy certain things, can't buy alcohol. I mean, they can really restrict a lot of things. So it basically allows the government really, in a way, to have total control over your finances. And one of the things that kind of opened my eyes to this was the Canadian trucker situation that happened. If you guys were watching that a couple of years ago, all these protests, I don't want to get political, but all these protesters went out and protested against the vaccine. And they basically, said these are terrorists, and which, okay, that's one thing, but they actually also, they said, if people donated to this cause, so let's say for me, I'm in my home and I have a business and I'm like, I want to support those truckers and I support the GoFundMe, whatever. Well, they were actually shutting down my assets and my business as an individual, right? So again, it just gives way more control, I think. So anyway, I'm really not, I don't think that it will happen in the US. I think there's enough knowledge about it. There's enough people, I think, in Florida, they actually banned it, just as a token, like, hey, we're banning central bank digital currencies in Florida, but there's enough awareness about it that if it were to happen, and I think it could happen. I think if there were a big crisis, there was a reason they could try, oh, this is our savior, whatever, and they could just do it. But I think it is a risk. I don't think it is the primary risk. The risk mitigation, like I said, people stop using cash. I asked actually Daryl Heller, who runs Paramount as the management company, what do you see as the primary risk of this deal? And that's a great question whenever you're looking at any deal. ask the operator, well, what do you see as the primary risk of this deal? And if they hem and haw, or they do, oh, there's no risk here, just turn and run the other way, right? They should be very honest with you, and they may give you a different answer than what you expected. So I asked him, and he said, well, he's like, we've seen this in New York. It's happened a few times in the last 10 years where they've tried to limit in New York City the fees. So they've tried to say, we're going to put a cap on it of how much ATMs can get paid at like $1.50 or a certain amount. And, they're not charging, they're charging $2 or whatever. They're not charging a lot currently, but it is a risk, and it goes up. And every time it gets defeated, like it hasn't been passed, but that is a risk, that it's almost like a rent control that could happen. Yeah,
absolutely. But again, people who have bought, there's the building that I'm in here, there was this like guy, and I walked by the door over here, and it said, there was a eviction notice, and it happened to read the eviction notice says hasn't paid rent since 2019. So some dude moved in here, COVID happened, and he just stopped paying his rent. He lived there since 2019. Just stayed in this place for like years. So there's risk in everything, especially if you're in real estate and you happen to buy the wrong place, the wrong city. So there's risks in everything, right? Diversification, we teach it in the course, and that's where it might be maybe I'll do an ATM machine investment and oil and gas and car wash or something like that. Diversification, and then real estate. I'll do short-term rentals, rent to nurses, and maybe some long-term rentals and multifamily. It's all diversification, but you got to spend the time and raise your financial IQ. Because a portfolio of stocks and bonds isn't going to get anywhere. So a diversified portfolio of stocks and bonds is not going to get you there. So we know that.
It's not going to get there for sure. So again, a few more slides. We'll finish this up. We got a few questions. So U.S. currency in circulation. This is the physical currency that's in circulation. You can see here, sorry, my chart's kind of behind my camera. So you look at 1960, we're like super low, and this is millions of dollars. So we've got a million. We're just way low, all the way along here. And then what happens in 2008 here, right? We go from it's below a million. I don't know what that would be, but the physical currency, and then all of a sudden just goes boom. So we're up here now at like 6.5 times the amount of physical cash than we had. That's just shocking, right? It's just like absolutely shocking. It kind of goes up and down. Why does it go up and down? Some of it has to do, there's various reasons that happens, but we just have way more cash. This is the Federal Reserve's number that actually they put out. So this is not my number. This is their number that they're reporting. So that's something to take note of. And then let's see. Anyway, this is just some other stuff about the ATM, and then I can do some Q&A on this. So I know there's a few questions here, and then happy to hear from folks too. We talked about the digital dollar a little bit. We'll come back to Bitcoin ATMs here in a little bit. Why does the investment end after 7 years? It's a great question. Well, the way this is structured is, we go to people. The ATM business is it's not about ATMs. It's really about the contracts. What I mean by that is when there's a contract in place for ATMs in a hotel, what'll happen is we'll know, okay, we acquired this, contract, or we acquired this, this property has an ATM here, and we'll look and say, oh, well, their contract's expiring 6 months. Well, we got to get in there and we got to see if we can extend that contract. Well, people generally, it's like signing another year of lease for rent. People usually don't like to extend for a long period of time. So what you do is you got to incentivize them. You say, well, hey, how's it going with the ATM? Oh, it's great. We like it. Let's get good. Well, how about, would you like to get a new ATM? Oh yeah, sure. We'll get you a new state-of-the-art one with a big screen and this and that. And okay, well, that sounds great. We had, everything will be awesome. Say, okay, we just need you to sign a new 7-year contract and we'll get you in there. So we were able to do that, right? We're able to get them a new ATM machine, which has a cost to it. That's what investors are actually purchasing. It goes into a location, and we expect that to last, around 7 years. And so that's why, it's interesting. Daryl Heller, I have a lot of respect for him, but he's been able to create a way that he can basically create more and more ways to get funding to go after and acquire more of these ATMs, as well as once they're acquired, go in and replace them by partnering with investors, right? So he's found a way to say, hey, let's create a win-win here. So that's kind of why it ends after 7 years. Now, again, because you're getting paid along the way, you're able to reinvest, which I think is a real benefit for sure.
Yeah, for sure. Yeah, it's a cash flow investment to give you 7 years of income, and then that's it. But again, you have the advantage of a tax deduction going in. If you put $100,000 in real estate, there's no tax deduction if that's a down payment on your real estate. Like it's, if you're a real estate professional, again, everything has its advantages and disadvantages for sure. So
yeah, exactly. So a couple more questions here. What are the fees? Are they after the preferred return? So this one is interesting. A lot of deals have kind of a share where it's like, okay, this percentage of the profits goes to the passive investors, this percentage. So for example, like an 80-20. So we've had multifamily deals from $1 of all the profits after the expenses are paid, it's 80% to the passive investors, the limited partners, and then 20% goes to the general partners. Well, this one is just, it's kind of it is a cap, right? It's like saying, hey, investors are going to get paid their 24.9%. And then what's above that just goes to the operator. And I've seen the numbers, and it's basically about an equal share. So the operators are making about as much as the investors. It's just, there are some seasonality where that goes up and down a little bit. And so they just weather that, right? So that's one thing that they're able to do. I can share my, I'm happy to share my information afterwards. If people have more questions or want to talk about this, we can talk about it. Bitcoin ATMs, there is, okay, so I will say this, within the ATM space, there is a big movement for basically like payment centers, right? Where you go in, you can buy Bitcoin, you can pay bills, you can send money internationally. A lot of people are using these Bitcoin ATMs. They call them BTMs, or basically, payment centers, or crypto ATMs. And they're very, very profitable, and they can send money internationally very cheap, and they're being used a lot. And so there is some talk of, is there a way to combine where you have these ATMs and then you combine, they're selling Bitcoin, they sell gift cards, they sell, or, you can do financial services, you can do different things on there. And even somebody mentioned the check cashing center. Some of those have been used in check cashing centers to be able to you can do all these different services at one thing. One challenge is that, there's a lot of service that goes into making sure those work just right. I think it is an attractive thing. I think I found it just a little challenging to get investors to understand what like a Bitcoin ATM actually does, and like who's actually using it. And so we have not offered it. There's actually this group that does this, also does Bitcoin ATMs. We just have not gotten involved with it yet, but we may in the future.
Cool. Awesome. Well, good.
So that's a quick overview. So now you guys, if I give you a gold star and say great job for listening, and if you have any questions, you can feel free to put them in here. And again, I think it is important to understand an investment profile, what it is, what are the risks, and what are the pros and cons of it, and how does it fit your situation.
Yeah, cool. Good. Okay, good. So credit investors, do we have any, I know people are definitely interested in like maybe the basics of car washes or oil and gas. You want to give us maybe a brief, quick overview of how that kind of stuff works?
So I've got presentations for both of those. So I can share one. Sweet. Which one should we do?
I think car washes are amazing, because car washes that seems to be an increasing market as far as, these car washes. There's probably subscription type of car washes, and those are going to pop up everywhere. And I can see that being something huge in the future, and it's not going away. Nobody's going to stop washing their cars, right? So these are pretty cool.
Yeah. So this is really interesting. There's a strategy here, and beyond car washes, there's a strategy, and it's called a private equity roll-up strategy. So if you remember that, like when I was a kid, we had these things called fruit roll-ups. You remember fruit roll-ups where you'd have those little things, you roll them up, you put them in your mouth, and they were really, my daughter still loves them. They have different names now, but this is basically what the strategy is. Now, if you have one car wash or one gas station or one dental practice, it sells for a certain multiple of earnings. It may sell for 8 to 10 times earnings or 6 times earnings, whatever. An example, car wash, if I had, one of these, it could sell for maybe 8 times earnings. If I have 50 of them that are of the same type, which is a lot, it's true, it is a lot. But if I had 50 of the same type, I could sell them instead of for 8 or 10 times earnings, I could sell them for typically between 15 and 25 times earnings, right? So you have a multiple value simply for putting them together. Now, why is that, right? Why is that? It's because the buyer, who is actually the buyer here, it's private equity. They literally have too much money. They don't want to spend, $10 million on one car wash. They want to, spend 500 million and buy 50, right? They want to buy a lot of stuff. So they have a lot of money to deploy, and having more of the same kind, there's a lot of efficiencies there. So that's just, before we get into this, that's the strategy of this. That's kind of what we're doing. It exists in other things. I've seen it in different types of industries. This one was really attractive to us. We did this earlier this year. We may do it again later this year. Tommy Express Car Wash. This is the It's one of the largest car wash franchises in the country. There's 150 stores, 0 have failed. They rank all franchises of any type, across food and cleaners and all kinds of things. Like what's the most profitable or highest revenue per store? Well, number one is Chick-fil-A. I think it's over 5 million a year and per store sales. Panera, I think, is number 2 or 3. These guys here are number 4. So they just per store, I think it's a little over $3 million a year that each store generates. So it's a very high revenue place. It is the membership model. People showing the goal of this group is to basically get people on and off the road in less than 3 minutes, get a professional on and off on the road in less than 3 minutes. Has anybody ever used a Tommy's Car Wash before? Anybody familiar with that? They're in certain parts of the country. But anyway, it's pretty nice. So I'm going to just share a little bit about this. Again, this is not an offer. This is educational. We actually don't have this one available now. This is just kind of getting the investment overview. We basically will use the building and the land. There's some operating expenses. There's a lot of operating margin there. If you have high margin like this, it's a good business, right? And so this is a good business, especially in certain locations where you can just work people through. It's super efficient. The people who run Tommy's Car Wash, they're just total car wash nerds. Like they're nerds, and like they've just found a way to like absolutely maximize this the best possible way, give people a great experience. This is all locations right now. This fund that we're doing, these are the locations for some of the stores that we are putting in. A lot of these we are building. I believe when we started, we had 7. Some of those were acquired and some were built. Now we're up to, I think, 13 that are built, and then we're building another 10 more. And so we're just really actively doing that to try to put together to eventually find a buyer, to cash flow along to find a buyer. So this just talks a little bit about, the group itself, kind of who they are, the equipment, some of the things about them. I'm just going to kind of breeze through some of this. And again, some of this is a little small. If somebody wants to see some, I'm happy to share some of this stuff later, but this just shows as well. Okay, this is it here. This is the slide here. So it's showing per store. Chick-fil-A, I guess my numbers were a little off. 4.2 million, in revenue. And then this was 2.6 million, which is basically just behind Panera. So the amount of sales per store. So you see this, everything else here is food besides Planet Fitness and Tommy's Car Wash. So that's pretty impressive, right? To have that much per store. And there's a reason way that they do that. So it talks about basically it's a very fragmented industry. No player has more than 5%. So if you look at the top players in fast food, the top like 5 or 6 players, they've got like 50% of the market. Well, this one is it's just very, very fragmented, right? It's very fragmented. So no one has more than 5% of the entire market, but there's an expected growth rate in these car washes just in the industry. Like we talked about, whatever market you buy in, is it a growing market, right? Well, this is a growing market, 4.6% growth per year on average that we're expecting in that market. It's just showing, the industry itself, it's very fragmented, which is good. The life cycle, there is some competition. So is there a way to do it? There's some barrier to entry, just kind of gets through some of the things that they score this different ways. This basically talks about, I don't really spend a lot of time on all this, but again, I think you kind of get the strategy of what we're trying to do here is to, and this is, I'll say this as well. Some of this is actually, there is some leverage that goes into this. So we also do get some depreciation through this as well. And then this deal, when we did this deal, I'm going to get into the returns here in a minute. It was capped, or meaning like investors would get their money back within a certain period of time, and then they were out of the deal. We've actually restructured, the group has restructured it to say you get some cash flow along the way, but you do share significantly in the upside. And so that's kind of a nice thing when you have those shared interests. And so how these deals are structured is important. There's submissions here. So this is basically kind of how the deal was structured. It's not really structured this way anymore. This shows year 1, 100K invested. There's 40,000 of depreciation. You get your depreciation over the first 3 years. By year 2, you're starting to get some cash flow. You see there's no real cash flow first year. You just invested, and then you start to get money back, and then you're getting quite a bit of money by the 5th year, about a 25% IRR. It is capped here, but it is, with the depreciation, it's about a 3-year payback. So we like kind of how it's structured. They decided to kind of change it where it's less cash flow and it has more upside to investors. And so this shows kind of the partners, kind of how they took over one location, and they were able to dramatically increase the revenue for one store. This is the management team. These guys have an impressive background, things that they've done.
Yeah.
And then, anyway, I'm just going to get, I think there's some Q&A. So that's kind of, again, I think the thing about this deal that I like is just the way that it's structured, the private equity roll up. It's a really solid team. And, it's again, now the question, I guess the risk that I find in any deal, right? What is the risk here? I think one of the risks is, will there be a buyer that when we're ready to sell, that they're ready to buy, right? Are we going to be in a really tough economic place, or will those funds from private equity dry up? We don't think so, but could it happen? It absolutely could happen, right? And so, but that's why having things that cash flow, at least they can, save you to say, hey, well, we're still cash flowing, we're still in good shape. Eventually we'll sell it, but we don't have to sell. We can sell what we want to sell. So that's why cash flow, I think, is so much better. Because if you have a real estate property, it's like, oh, it'll be worth some money someday, but really not making any money. Well, it's pretty easy to go from not making any money to we're actually losing money, and we're not gonna be able to keep the property, right? Versus your cash flowing, you're in really good shape.
Cool. This is also accredited investors.
This is accredited. Yeah. I think these 3 deals are all accredited. Again, for some reason they've just structured them that way. We've had some that are for non-accredited investors that are our multifamily deals. A lot of them we've done are for accredited, just because it's a couple of reasons. One is it's a little less risk financially, or even for liability wise for us. And then we can actually publish this more widely. If this were a non-accredited deal, I couldn't really present this widely to your group, because it's only, it's supposed to be shared among people that I have a financial relationship with.
Right. Totally. Well, very cool. Very cool. Well, good. Yeah, I don't know, like, if we want to, should we go through anything on oil and gas stuff, or is that something that's even, or we can maybe do that in the future? What's your thoughts, Bronson?
We can. Yeah, I didn't see any. We have any questions on this? I didn't really see. Somebody's asking if there's one for for storage units. I don't have one for self storage. That's also a great asset as well. I'm happy to go through oil and gas as well if you guys want to go through that. I don't want to overwhelm you guys too. I know it's a lot of information.
Yeah, exactly. I think my brain is pretty.
Yeah. So maybe we can do oil and gas another time, because
oil and gas is cool stuff or whatever. So
people want to sleep. Yeah, hopefully you guys go with me there. Yeah.
Out of curiosity, with oil and gas, is it actually physical property, or is it wells? Is it what? Just a general, like, what's the investment when you say that oil and gas?
Yeah. So we do. We've done a couple different things. The one that we're working on most recently it's called non-operated working interests. And so what that means is basically when we go in with our fund, this is like a $30 to $50 million fund. We bought this. The first piece was a $30 million property. It was several thousand acres, and it has 140 wells currently on the property. And so it's producing right now, we got a great deal on it. It's producing around 13 to 15% cash on cash from day one, right? So we talk about cash flow. That's pretty amazing, right? It's just producing right at the get-go. But for us, because we own, basically own the mineral rights to the land, we have the right, but not the responsibility. We don't have to, but we can participate financially in future drilling that these operators are on the property doing. So we have leases in place where Marathon Oil, which is a large driller, there's several large national drillers that are there. And, they've done tons of research. And they're like, hey, we want to put a well here. And say, okay, well, and they're like, do you want to participate? And we'll say, well, yes, we do, or no, we don't. So we'll do our research and we'll say, well, this one worked. Well, let's do that one. We've got all the data. So we'll decide, hey, we'll go in with them and we'll do this. And so, we participate by doing that. And so by doing that over the first year, we're withholding all the cash flow and using all the leverage to go into 45 more wells, up to 45 more wells. And then we feel like that is going to dramatically increase the cash flow for the property. And then eventually, when the right time is to sell, it could be a few years, it could be up to 10 years, we'll sell it for a profit. So there'll be kind of, cash along the way, and there'll be a big lump sum at the end. So there's kind of a mix of both cash flow and appreciation. There's also some tax benefits that go with it, but I like it because, and there's a lot of, people that have invested in oil or invested in other things. And a lot of it comes down to who the group is. There's been a lot of vetting done in this group. It's a 40-year oil group that, people that I know super well have a 25-year relationship with. And their last 5 funds of the last 20 years have returned between 21 and 80% per year. And so, I background checked. Actually, the partners themselves between these two groups are putting in about 7 million of the 30 to 50 million, which is always a really good sign, right? They're putting their own money in.
Yep.
So those are things that I like about it. Generally, honestly, I'm a little skeptical of oil and gas for the reason, it's just like, I'm not an oil and gas guy. I don't really fully understand whatever, but, I feel like when you know who's involved, you feel like you understand the market, or what's happening, why was this purchased in this way, what is the goal of the property, where are we headed. So that's kind of the heart of this particular oil and gas deal.
Yeah, for sure.
Awesome. Thank you.
Well, very cool, man. This was good. It's always good to learn about these different things. And I'm sure there's some people on this call or might be interested in that ATM stuff. I don't know if they are, they can text me and we can just, get their questions answered, but we'll go from there. Anyways, get Bronson's book. It's awesome. And I will be at his event this coming Friday, and it's going to be good stuff in Los Angeles. So if you're in Los Angeles, you want to get to that, just let me know and we'll get you there too. So, all right. Well, very cool, man. It was awesome to have you. I'm sure we'll grab lunch again because you're not far away. And before me and Stella end up in Tennessee as we're exiting California.
Oh, you guys are moving. I didn't know you're moving. When are you moving?
We're basically buying a property right now. We'll close at the end of this month. We just got to do some renovations on it, and then we're just gonna probably rent it for a little bit, and then eventually move there. And we're gonna scout out other real estate in Knoxville, Tennessee, because
Knoxville. Yeah, I've got some good friends there in Knoxville. It's a nice area. Yeah.
Oh yeah, for sure. So we're told that you get a house on a lake, and they're not even that expensive for a beautiful house on the lake there. I'm like, this is amazing. So yeah, we're looking at getting there and just getting more into the real estate, because in my opinion, real estate's just going to keep going up. I mean, they're printing more money. They're printing another couple of trillion. As you know, BlackRock, these companies are going to want to buy up all the real estate. So I really do believe that the people on this call, you really, really should put some attention to getting on some more real estate under your belt in the next 24 to 36 months, because it's only going to get more expensive. For sure. I mean, I don't know if you have a same opinion on that, but
yeah, I think there's definitely some opportunity right now if you can make the numbers work. I put the link to my book there, and then the conference, and then I've got my email in there too. So if somebody wants to reach out, happy to connect. And always great connecting with you, Mark. I'm excited to see you in LA here in a couple of days, and we're going to have a good time at the summit. So
absolutely, sounds good. Hey man, thanks for your time. We're going to go over some other stuff with the group, but man, I appreciate you, dude, for sure.
So no problem. Thanks everybody. Really appreciate it. Thank you so much.
Yeah. All right, cool. So how was that, guys? Any questions on that? Comments? Pretty cool stuff.
That was pretty amazing, I have to say. Thank you for doing that.
Yeah, he's just a really trustworthy guy. He's a group of people that are really cool. I've met him. He's like just a good, ethical, guy, upfront, risks, rewards, that sort of thing. So, and I like that. I want to be in a 1% tax bracket, right? That sounds like fun. Mm-hmm. So for sure. So all right, good. So I know we have our orientation class, and this group for the perfect portfolio is very much out of order. We just kind of threw this in the middle, but we do have our orientation class coming up next Wednesday. So that's going to go through stuff about the financial industry, how it's structured. It might shock you a little bit how the financial industry is built and who provides the financial education to people, and why me and Bronson call ourselves recovering investment advisors and stuff like that, because we find out there's just a lot better investments out there when you really dig down and sort of like specialized and increase your financial IQ. So I do want to comment a little bit, because I know that a lot of people had questions on these closed-end funds that we purchased, and I'm just going to cover that really quick, and then we're just going to call it a class here. So just how do you participate in your group? Ben, email me, and maybe Norelvi can throw my email in the chat, but just email me or Norelvi, and we can get you into the class. So, but we'll talk about what's called GOF and COM. Okay, and I think this is a good opportunity, because a lot of people maybe put some money in there, like, what is going on here? Why did these things go on? So I'm going to open my pie on M1, and we can talk about these things a little bit and just kind of raise your financial IQ in something you're probably even may have a few bucks in, right? So, okay, so let me bring up my M1 account really quick here. Okay. Okay, so again, we're gonna go through some stuff and you're probably like, hey, I don't quite understand this stuff, but that's okay, because I didn't understand this stuff either, but I just keep raising my financial IQ, right? Okay, so let's jump into my pie and we'll just talk about what it's made up and what it's doing and why I'm pretty excited when I see down markets. Okay, so let's look at my pie here. As you can see, the last week has not been good. It's down 8.7, but here's why I don't care. And it's kind of exciting, actually. See, we're cash flow investors. We want to build income streams, right? That's sort of the purpose of this course, is to build income streams. When these prices drop like this, that just means I'm buying larger income streams for cheaper, okay? So you buy something at a discount, you get a much larger income stream for a lower price, okay? And that's what's happening right now with this recent downturn in the markets, okay? COF is a closed-end fund, and GOF, they're closed-end funds, okay? Well, closed-end funds, again, we're gonna jump ahead a little bit, are very unique. They're not like a traditional mutual fund or like a traditional exchange-traded fund. They have something called a net asset value. So let's go to a website called CEF Connect. Closed-end funds, we'll show you kind of a little bit of how they work, okay? So if I put GOF here, okay? GOF is what's called a closed-end fund. CEF is closed-end fund Connect. It's kind of where to do your research on these things called closed-end funds. Now, why do we like GOF? Because GOF beats the performance of the stock market prior to 2008. Okay, it's kind of cool. It's got a really large dividend, but it has this dividend right now. It's currently at almost a 19% dividend. Okay, because the price dropped, the dividend is this high. The price drops, the dividend goes way up. Okay, now normally, if you look on the history of this thing, there's maybe down in the market. But there's this thing called NAV and the price, okay? If you look at the 1-year graph on this thing, this almost never happens to these types of funds. Closed-end funds, the price is actually down at what's called NAV, and this won't stay there very long. It's going to bump back up.
Well, you can look at this, right? So here's the thing. The actual value of the net asset value is the value of the portfolio and the actual assets that it holds. If you notice, the high point on the 52-week high point is $13, right?
Yeah.
And the low point, right, is $11. So there's a difference of basically $2 in the portfolio. The only thing is that this portfolio is really popular because of the dividends that it pays out, right? Yeah. So then what it does is it increase the market price. So when we're buying it at the market price. So what has more volatility is the market price. Now, what you would like to do is buy this at a discount, which is finally at a discount, because it hasn't been at a discount for years. So if we go further down on where it says distribution or price info.
Right there. Oh, pricing information.
Yeah, price info.
Yeah.
Now, if you go to since inception on that graph, right? You see how the line is above that? So it's been at a premium for a really, really long time. There's very few events that you can actually buy it cheaper than the actual value of the portfolio, right? Now, if you understand this portfolio and you go look at the objective, it has a lot of levers in what it invests in, but it's different than a lot of the other funds that are there, because it's actually bonds. It's not stock. So it's not equities that's at this end. It's just different bonds. You can go, I encourage you to also go for, to learn what it has. If you go to Guggenheim, right? If you put GOF and you actually go to Guggenheim, right? Which is the fund, they'll give you the full perspective of all the different assets it holds, which is a multi-bond strategy, and the biggest percentage are in senior loans and are in high yield bonds. So those have volatilities as well. So you can start to understand what it actually holds. But when the market drops that way, it can be an opportunity, right? Over time, where you get a lot of cash flow or better cash flow on entrance. If you started higher and you're still dollar costing down, meaning that you're reinvesting or you're adding money, your average price will actually come down. So when something recovers or the fund recovers, it's easier to get back to the principal that you actually put in. But in the meantime, your yield per share stays high, meaning that you're cash flowing more. So, you know, which I don't know if you see some of the correlation on how Bronson was talking about the investment that he's in, even though it's alternative, right? You can utilize with that. So the different with these is usually they have two prices, right? And when the market dropped, it must have been, to me personally, again, you know, I don't know the specifics in it, but what I could see was basically people were just selling, panic selling on a certain thing because they might think the dividend will drop. You know, there's a whole bunch of different things. But when it is at a discount, it could bring opportunity, you know, to buy it at a better price. Does that make sense?
Yeah,
So,
it just looks like it's way oversold for some reason. And the thing what people like about this fund is it's got this dividend coming in, right? Consistent dividend. The dividend's always gone up. Like historically, the dividend keeps going up and up and up and up and up in the history. And that dividend is a lot of it's actually tax-free. Okay. Something called return of capital. This little column here called ROC, closed-end funds are kind of for income and also tax advantages. So a lot of that income is actually tax-free because it's a return of capital. Okay. So this fund is very unique in the way that it's built.
and yeah, and the accounting side of it is how they manage their fund. So they have different ways of fundraising, different ways of paying out and doing all those different things. That's what the fund manager does. Because by the way, when you're buying this, you're basically leveraging fund managers to run a bond fund for you. That's basic, that produces revenue. So at the end of the day, I mean, you know, obviously do your homework, you know, learn from it, but this is where you could see different opportunities. I mean, we can't predict the future. What's going to happen, I don't know. But if you feel like it's going to recover, right? And all you could do is, so if you go to, for example, TradingView and you just look the historic chart, you'll see that they've had huge drops, but they've found a way to recover. So if you believe that those portfolio managers are going to basically buy and sell different bonds that aid, you know, and keeps the value of the portfolio and raises it over time, then, you know, this could be a good buying opportunity because, you know, there was a panic sale.
For sure. It's just the price is down, see your portfolio go down, but that the income jumps to 19% dividend yield, which is mostly tax-free. And then you also have the recovery of the portfolio there, which, you know, it's likely going to jump. It went up like another 4%. So I think this is a great opportunity. Don't worry about the downturn and things like that. I don't really care. Plus, go ahead.
I don't know if this question was answered already, but it's they're asking how much leverage is in this closed-end fund.
You can look at it right on cfconnect.com. So if you're ever curious, and great question, by the way, if you go to GOF, hit all. Right. And then just slide down and you should see what's the leverage. Last time I checked was 19%, 19 or 20%.
Yeah,
right there, 19.8%. Effective leverage. So what's their total investment is there. And then you could see common shares, and then you can see actually what's the loan for, you know, off margin.
Yeah. Now the other fund we own is called CLM.
Hey, Mark, can I ask a question real quick?
Yeah.
It's just either Danilo or you can answer this. So this thing's gotten smashed in the last 3 weeks.
Yep.
I mean, I know we're in a volatile market. We've been volatile since the middle of August. What would your suspicion be, other than it being oversold? Because clearly it's oversold. We're under NAV. What would you suspect is the reason that this thing's just gotten hammered over the last week?
Great question. One of it is that it's a really popular fund by many people because it trades at premium, right? And they can actually drip and they can do a whole bunch of different things. But they might believe that because of the way it's paying out and where the fund's at, that it might have to drop its dividend, right? to maintain the value of the portfolio, right? So it's integrity, it's solvency, all of that different things. So they might drop the dividends. If they believe that, they'd prefer to cash out, wait till that drops and go back in again, or go into a different fund that they believe that might have a better price point of entry. So there's a lot of, if you go to a lot of the channels that are out there, right? The Reddits and all those other things. So think of meme stocks, right? Sometimes when it groups together and they decide, hey, we're going to just switch because we believe this could cause that. Because if you actually look at its net asset value, you don't see the big change. It's the fact that, if you bought in on the high price of the market price, right? Of the share price, right? As opposed to the NAV price, then you'll see maybe a little bit of a bigger downturn. But the closer you are at NAV, the closer you're buying it at its base price, or if it goes below, the more you're buying it at cheaper than what the actual value of the portfolio is. So hopefully that answered your question, because it wasn't anything specific in a statement, and I didn't see anything specific that would be out of the norm from the actual net asset value of its portfolio and what it was invested relative to the other funds out there as well.
Yeah, and that's the thing like that. So that's why you diversify, right? You'll notice my portfolio is very diversified. I've got GOF in there just because they have a history of managing money since prior to 2008, and it beat the performance of the stock market, right? So that's cool. Then I have CLM. CLM is also a closed-end fund. The dividend's up to 22.26%. Not bad. Okay. Distributions again, return of capital, a lot of return of capital, either return of capital, long-term capital gains. So it's built for tax reduction as much as possible within the fund, but I'm also combining that with other things, right? I've got my SPYI, that's a 12% dividend, also tax advantage. So the top three are like tax advantaged, that sort of thing. And then I've got my Tesla and NVIDIA. Those are my huge, crazy dividends on my Tesla and NVIDIA. Those are cranking in there. So those are going to keep coming in there, and they're going to buy the ones that are down the most. And then to supercharge my portfolio on the upside, I've just got a little bit of 15% of SPXL. That's the stock market times 3. So I have a very specific purpose with this portfolio, right? I've got my high dividends, my tax advantages, diversified portfolio, got my huge dividends with Tesla and NVDY, and then I've got SPXL, and they're not really much of a dividend, but that's just a supercharge. And I can just let this go. If I'm adding more money to this and the dividends, eventually this thing's going to keep making me, growing and growing and growing, and my income's going to keep getting higher and higher and higher.
Yeah, theoretically speaking, if you look at it, it's high cash flowing, right? And the triple leveraged, and by the way, if triple leverage scare you, SPY or QQQ, just the index alone, if you give it time, it'll appreciate, right? So that can actually protect the principal of your portfolio. So you can now have a higher cash flowing portfolio, but still have something to aid in maintaining the principle of what you put in there. Because if those high incomes could, actually erode a bit in the actual value of share, then if the other one's growing, it can offset it. So if you just take that principle and idea, you can start to literally create a portfolio that fits what you would like. Maybe you want just half of both, right?
Yeah.
So it's really up to you.
Yeah. And just CLM, it goes up faster than the stock market, and it goes down faster than the stock market, right? But over time, it really beats the performance of the S&P. So I'm going to hold CLM until the market crashes, or until the market recovers. Once I hear the stock market's at a new high or whatever, I'm just going to dump CLM because it just goes down faster. But at the same time, I'm getting this 22% dividend coming in there, which is awesome. Okay. And it will recover. It's not going to stay at those lows because it's too low. So yeah, for sure.
And by the way, if something new comes out, right, and that recovers, you can actually just repurpose that share because they might have something better than that.
Okay. Now, again, you have to choose what kind of pie. Maybe you're like, I don't really want that SPXL. That's too volatile. I don't want that in there. You got to just pick something you're comfortable with. put $100 in there and then start raising your financial IQ and then start adding to $50 a week or whatever, just whatever you want to start with. Now, another type of pie that is pretty cool and is this one. Oh, something went wrong. Come on.
Were you stationary too long?
Retry. What? One doesn't like me anymore.
Your pie blew up.
My pie blew up, disappeared, all gone, and it's gone. I don't know if you ever saw that video before, and it's gone. So kidding. All right, go. So this is another one. This is this is becoming my somewhat fun strategy. Okay, if you're like an individual stock person, you have experience in individual stocks and you like them. Okay, you can take like a Tesla and Nvidia and Apple. What other ones are available on M1? I'm not sure.
Yeah, that's it so far because OARC is actually a fund.
Okay.
I mean, you could buy ARC.
Yeah. So this portfolio is also built a very certain way. This can work good in a Roth IRA or an IRA or even a custodial account. This type of thing. If you have a long-term horizon custodial account, set one up for the kids or something like that. This can be a very cool pie. This is 25% Tesla and 25% Tesla, which is the dividend, about 50% dividend. Okay, that's going to be cranking in there, just 50% per year dividends going to be cranking in this portfolio. And I have Nvidia, which is a dominant company in AI technology. And then I've got NVDY, which is the super high dividend portfolio. So this portfolio is constantly going to be feeding itself. If Tesla and Nvidia drop in value, the dividends will start buying more of it, right? If the market's going up, Tesla and Nvidia will go way higher than the synthetic cover call, way up, way faster, and then I can borrow from that on margin at 7% and buy more of the ones that are paying 50%. So I mean, it's a very cool portfolio. So again, you can decide, or you can say, hey Mark, I saw what you're doing there. I saw those portfolios, and like, how should I build mine? We can give you some super starter one or something like that, but this was really just a kind of a opportunity to expand your horizon on what type of thing. This one's cool because I'm never going to sell the Tesla and I'm never going to sell the Nvidia. I want to hold that for the rest of my life. I'm never going to sell it. That way I'll never be taxable, all the growth of the stock. If I ever need money, I'll just borrow at 7% interest, right? And then on top of that, I've got those huge dividends of 50% coming in the other portion. So it just keeps feeding itself for the rest of my life, So again, a couple different pies that we've kind of developed over 2.5 years. And this stuff didn't exist 6 months ago. So it's pretty crazy. By the way, they created some other things that aren't in M1 are positions called QQQY. That's about a 70% dividend. And then there's JEPY, JEPY. That's not available in M1. But when those things come out, I'm probably going to pepper that a little bit in my pie, and I'll end up with more positions with even higher income streams between 50 and 70% dividend being added to those. So we're constantly going to have to kind of update our pies or things based on new innovation in the marketplace. But lots of good stuff, and it doesn't take much to retire. Imagine you had like 150 grand. Imagine you can get 40,000 a year out of that, or 50,000 a year. That's kind of realistic, because here's what I'm talking about, is that this pie, I mean, if you have a $200,000 portfolio, if you get a 35% dividend on that, that's 70,000 a year. It doesn't take much to retire when you have the existence of these types of funds. And of course, we have our new fund managers at Zega who can manage a portfolio for you if you have larger portfolios. So anyways, just wanted to comment on that because I know people had questions about that, but I love it when stuff drops because my income goes up faster. My pie constantly buys more. I'm constantly adding more money every week. It just makes my income grow even faster. So, right. But yeah, at some point in the future, investments go bad sometime, but that's why you diversify and, the stuff we invest into isn't, they're not speculative companies. They're either big indexes or really big companies that are incredibly profitable with big futures. So cool. All right, so it's 7:30. That was a lot of information today, but how many people raised your financial IQ today? Cool. Well, good. That's the whole purpose of this course. Don't be like, I don't understand this stuff. I didn't understand anything, when I first started this stuff. I was reading Rich Dad Poor Dad. I didn't understand anything, but I invested in my financial IQ. But I had to learn all the stuff that didn't work before I learned buy, borrow, die, and this stuff. So you guys can at least spend the time on the things that do work, which is, brokerage account, life insurance for the asset protection, and then real estate. Cool. All right. So we'll have our orientation class is next Wednesday, 6 o'clock. And we'll see you guys there. If you want some new student, if there's some new students and you're like, man, you guys got to come into this class. Great. Again, some of our students who went through the course the first time, like, I didn't quite get this. And then they come back again. We don't charge our past students to come back and attend future classes. So they get to constantly keep raising their financial IQ and learning some good stuff. And we'll bring you some good opportunities. Last but not least, we do have a very unique opportunity. If you happen to know people that work in the hospital industry and they're connected to hospitals, we have an opportunity to help hospitals make money and make an incredibly large amount of money helping hospitals make money. Because if we help a hospital make an extra 40 million, we get a little piece of that. That's a chunk of $40 million. So, and hospitals are in trouble if you don't know. So we've talked about that, but throw it out there. If you happen to know somebody who works in the hospital industry tied to executives, definitely connect us on that, because that's a very quick retirement plan, like really fast. So, all right, guys, have a great evening. Hopefully you guys raise your financial IQ and you're just excited about, what you guys can do the rest of the year and all next year off building cash flow, building income streams, right? It's time to get financially independent so you don't have to work anymore. Okay, so let's set that a goal for yourself in 2024. All right, guys, have a great evening. And, we'll see you next Wednesday, same bat time, same bat channel.